Here is a spreadsheet from John Hull's text, Options, Futures and Other Derivatives. It shows using a delta hedge as a strategy in place of stops in uncertain times for small and micro traders. The original was for institutional traders, as the spreadsheet calculations were in hundreds of thousands and millions. Hence, for big traders, it is effective anytime. However, for Soho traders, small office, home office, micro and small traders that is, it is not. If we establish micro traders are less than 10k in resources, $10,000 that is, and small traders are generally $25,000 to less than $50,000 or $100,000. Why does it not work? Regardless of investment size? Because as you will see from the demo, the buying of shares as it rises can, and often does, become more than the option premium payoff. We are only looking at weekly hedges to minimise costs, as daily transaction costs incur more fees and work. By that I mean decision making. It is a Monte Carlo simulation of a delta hedge where you buy 50 shares and write a call against it. It's not a covered call where you buy 100 shares and write a call. You buy 50 and sell a call at a delta of 50. It is hedged. Okay, now we're looking at the spreadsheet. This is the cumulative costs that pay off the total cost. Now the share at the purchase time was $11. I assume the interest rate's about 3.54%. I haven't looked into it exactly. To be exact, you'd want to get that right. The volatility is around 43%. It's very high because it's a volatile time. It's implied volatility I use. That's a whole nother area, a whole nother topic we can discuss another day. The strike is 11 to match the stock price, and the number of shares was 50, and is call is true, and the option price was 42. Now over here I've done a crude table to calculate the profit on the cases. Now this is a base case where it generates random numbers and it generates a stock price. That's our 4 weeks, because there's only 0.821, or 4 weeks divided by 320, let's see what I've got, 30 days divided by 365. So that gives about 4 weeks. 1, 2, 3, 4, 5, 6, 7 weeks. I don't know why it's got 7 weeks. Oh no, that's 1, 2, 3, 5 sixes, approximately, roughly. And that's the reverse case against the simulation to that. It's called the antithetic case. It's a reverse of the base case. Now you just press F9 and you can see multiple scenarios. What I'm trying to demonstrate here is why it's more effective than using stops. Stops are very hard to use, although I'm using them in my trade, and I'll show in a minute, as well. Because I don't lose money if it suddenly rises because of the problem which I mentioned, that the shares, if you have to buy too many shares with low income or a low base of income, you will lose. Now we'll just generate a few cases and see if we get a losing proposition. Oops. Profit of $11, $16. Profit of $20, $8. There's a loss. we had to sell the share. The share became $12.63 at the end of the period. We lost $1.63 on the share. We had to buy 100 shares at a loss of $53. The anesthetic case was a profit. So see, that's how it works as a micro or a small trader. If you got more than $25,000, I think you could probably say you could get out of the situation. The difference between being a micro trader less than 10,000 or even less than 25,000 is you cannot make more than 2 transactions on the same option in the same day. You're not considered experienced enough to be able to do that. It's a ridiculous situation, but that's what the SEC says. So even if you see things go really drastically awry, there's nothing you can do till the next day. Otherwise you'll be suspended from trading. Not many people realise these things. If you haven't got 25k in the account, you're not considered a day trader. You can't trade the same option more than twice in a day. Simple fact. With the recent change of government and they're completely abolishing all restrictions on anything, one of the good restrictions they may remove may be this silly clause about not trading 2 options in a day. Apart from all their other changes, I'm not an American, but they seem very bizarre. Anyway, I'll pause here and then I'll go to my actual share to show you how it's faring, okay? I'll just run a few more demos. See it change. See, minus $10 profit. Most of the time you do profit more than not if we run a few more. $8, $15 loss, $51 loss, $21 profit. So you're not making huge money, but you're not losing. It's a strategy for dangerous times like now. In good times you would ride a covered call. But there is definitely not trending up at the moment. Okay, well I will pause now. As you can see, I've got a micro account, and I'm trading DHT because it was the best return I could get for the cheapest stock because I haven't got much money to play with. I didn't do any fundamental analysis or any tricky quant things. I was just bang for buck, cheapest stock, best return. It's quite solvent. I had a bit of a check for that. It's quite liquid. It has a good cash flow. I did a tiny bit of fundamental analysis, not much. I just chose it fairly randomly actually. It was just pretty liquid. It was fairly cheap and it gave me 42 cents for an option for a share at a price of $10.75. You can see I'm losing $8 at the moment with the option not quite matching the share. The hedge is 55 and the option is 5 basis points off. That explains the $8.25. It fluctuates so wildly at the moment with the market being in turmoil that tomorrow it can once again be back in the black then. But it's always for a small amount, so I haven't worried. There's been no need to buy extra shares or sell extra shares. In fact, when it expires in 11 days, I'm pretty sure it'll be down, so I'm just going to ride another call. I'm not going to sell the share and take a loss. I'm just going to ride it and keep on sailing it down until it turns around again, which it eventually will. Who knows how long. But yeah, I'll take $40 for 30 days. Indefinitely. It's not much, but you know, when you only got $2,000 to play with, you're happy to get a return of that. As you can see, I started trading futures at the beginning of the year thinking the American market was going to love the new regime, seeing as they like people of bombast and who tell pretty basically loose with the truth and reality. Americans seem to go for all that sort of nonsense. So I thought this guy would do well. But the futures tanked straight away and I lost a lot quick and I got out. And that's why I'm teaching delta hedge as a trade. In times of trouble, a delta hedge is your best friend. And I do have stops because I'm such a small trader. If it goes up, I can't afford to let it rise because I'm not going to profit because the option will be called away. So I'll lose about $11 if it reaches $11. And at a price of $8, which is 20% of the original price of $42, I'm going to write another call and I'm going to let the stop close it out. I'll make a gain of what's that, $35, which is alright. And I'll write another one and write it down like the other one. Anyway, that's my strategy to go along with the story on the Monte Carlo simulation. It's a shipping stock if anyone's interested. It's not of any great merit or significance. It was the cheapest one I could afford that gave a good return for the option. You could probably do better or worse, I don't know. It's fairly liquid too. There's not a huge difference between the call and the bid and ask price. That was another criteria I looked for. Anyway, I'll sign off now, thanks.